If you've been seeing the recent huge spikes on gold but haven't had an opportunity to take a trade because the market won't retrace to your point of interest to give you an opportunity to enter, you're not alone. I'm going to try to explain what causes these kind of market conditions, why you're sitting on the sideline while the moves that you anticipate are happening, and how you can trade in these types of market conditions. I'm going to try to make this video as concise as possible, but there's a high chance that I may not be able to fit everything into one video. So if you see this video on whatever platform, TikTok, Twitter, IG, I'm probably going to have to break it up into bits so it's algorithm friendly. So if you see this video first, please check the rest of my profile or page wherever you see this to see the rest of the videos. This is how the market moves. There are two types of market regimes. The normal market regime is characterized by impulses, then retracements, usually to below 50% of the range. So you have your order block somewhere here or your fair value gap somewhere here, and then you want to see price create some form of liquidity, take it out, then continue the trend to the upside. This is the foundation that most trading strategies are designed around, and this is what most traders like to trade. This is normal market conditions, and it's called a mean reversion market, where the market impulses, retraces to about 50% of the range, then continues the move. Most of the time, this is the market condition that you will be in, and that's why our strategies tend to work. However, there's a second type of market condition, which is called the parabolic market. Parabolic markets are often catalyzed by geopolitical reasons and sentiment. In those market conditions, our technical analysis breaks. The market is not moving because it's respecting 50% of fair value or liquidity. It's moving because there is a global sentiment that is driving price. Usually, it is characterized by something, a geopolitical event. If you were trading in February, March, April of last year, you would have noticed it on assets like Euro USD, where Donald Trump started talking about tariffs and all of a sudden Euro USD just took off. In moments like that, you will see 8, 9, 10 days of straight bullet price action. And you, as price is going up, it will be creating huge impulses, fair value gaps on the daily time frame. So you see daily fair value gap here, another daily fair value gap here, another daily fair value gap here. And if you're on the 4-hour or the 1-hour time frame, you're seeing 6 or 7 different fair value gaps. Being a mean reversion trader, what you're waiting for is for price to come back into one of these levels, preferably in discounts. You've identified your fair value gap, you've identified your point of interest, and you're waiting for price to come down, but it does not do that. Parabolic markets are often characterized by this type of price action. You would have seen this before. Impulse, then a very small or a shallow consolidation, and then another impulse. Now, this is the problem, because when it impulses like this and you see this pause, what you're waiting for is for price to do something like this, but it does not do this and you don't have an opportunity to enter the trade. So, how do you trade?